the previous function, we saw how the remainder errors are able to point to an opportunity to either withstand the the variables, or to decide not to buy into the error, that it's not a pricing error, it's not a function, it's not an error of the function. So in this case, we're using applied math in financial markets. Okay, is that because liquidity suppliers are getting paid to sell stock, so the one thing that they're going to want to do is sell at a greater price. So what happens is when they want to sell, the price actually, the cost of the stock, I forget if it goes up or down actually, but they want to sell stock. And so the idea is that in the arbitrage opportunity where the remainder error was obvious, you really kind of have to look a little bit deeper, okay? Because I don't think you're with me yet, because we're talking about continuous time variables. So in the event where you saw that our opportunity could have been there because there was an error and there was a discrepancy, which it could have been a discrepancy, we're theorizing whether or not we have to fix our mathematical models, because our mathematical models are going to be a function of a function. Hold on one second. I'm going to end this right here. Okay, back. There's somebody here. There's always somebody here. And if you do care to hear a story, or you want some more of me, because I know you like what you see, I mean, like if you could reach out and kind of hit the like button, I would like you to do that, like right now. So in this instance that you hit the like button and it was real time and it wasn't live, we could say that that's an event that we can model, and the intervals of which somebody hits the like button is a function in of itself. Okay, so that's what's going on, in the price volume activity. When you're looking at continuous time, you're actually, I don't need you in my life. You can hang up the phone, right? So it's like you're watching this and you're thinking to yourself, like, wait, what did he just say? I just hit the like button. This wasn't live, but it was live. But I was just like, really? Like, seriously? No. I'm messing with you. There's somebody on the line right now and they're bugging the heck out of me. So it's really good to see you again, actually. And I can't see you, actually. So the continuous time variable is that we're looking at this event, right? I mean, if you wanted to make a function out of it, you're looking at this event and you're seeing where it goes wrong. So you're seeing at the point of which you should probably either do something or you're going to do nothing, because You don't want to have to revise your models. We're just theorizing based on random error, or not random error, remainder error. Okay, and so there's going to be a point where the volume spikes in the price activity. If you were a market professional, or you are a market professional now, you know exactly what I'm talking about. And so there's the arbitrage opportunity, and it vanishes like that. It's already over. It was like half a second, and we'll learn about it right now. And so that way we can say that it wasn't an arbitrage. So that whole thing it has something to do with being able to discretely derive what is a continuous variable. So continuous time means that not necessarily there's 1 and 2 seconds or 1 and 2 periods. It's that there's going to be continuous periods. There's going to be continuous time. So we're integrating this entire function continuously. So it's you can say it's live. I don't know. I mean, I'm not an expert at it actually. And so the big thing is that their opportunity has already passed, and we know that they most likely didn't take advantage of this opportunity. So what we should see now is that because there's a negative interest rate, the convenience yield is also negative. So the cost of wearing all this stuff that I have at my business here, because this is my business, and there's somebody on the phone here all the time because it is a publishing business, and there's somebody always accounting all the time because it is a place of residence as well. So I'm constantly having to get down to what is the cost of holding all of these books, because it's not a laughing matter. So that was the joke. The opportunity is already gone to arbitrage based on price. Okay, so if I wanted to, I can make my own price that I wanted to. Okay, because there's nothing efficient about what I'm doing. Okay, it's a joke. Okay, what's your favorite? It's not gonna be Mick Jagger, because you're getting satisfaction from this. And so the big thing is that the convenience yield when it's negative. And if you are listening, if you are watching this applies to math. It's basically I'm a math, and so it's what I think about. It's what I'm thinking about right now. This is everything. It's my everything. This is everything I think about. Is that you're pushing the prices lower because the convenience yield is negative. So if I'm having to pay all this money to sell books, my books are going to go down in price. So I'm going to wholesale books is what I'm going to do, and which is basically what I do. Not necessarily what I do. I retell stories. And the shortening of supply of books means that the price is going to go up, but there's a pressure to bring the price down based on the convenience yield, because it's costing me a fortune to do this. And if you were following from last time, okay, I had a really good function going on, and if you could fix that, I mean, you'd be nuts, because you don't need to fix anything. because this opportunity arises on intervals like you saw just now or 5 minutes ago. It's that when you see a spike in activity, you can say, if you were honing your mathematical models on this variable, like for instance, if it was a dark liquidity pool, or if it was on the open market, if you were targeting that as liquidity suppliers increasing their activity, what this means is that when it tapers down, you can say that that increase in activity should have been greater than the sum of the activity prior, based on the latency of which that this variable trading firm, whatever it is, king of the crop, is doing to your entire function. So like the latency is when they're going to pull the trigger. So that they already did it, and it has to be greater than the sum of the time period interval that you declared was a part of this remainder error in function. So the function is that you have continuous time as a function of a function, but you see now that as you may have noticed, that continuousness, that continuity is like a band that can be expanded, so it can take less time or it could take more time. So if we're looking at it at a longer time frame, we notice that the arbitrager in the event where it was available, because it did occur and it occurs in intervals. No, we don't have to fix our mathematical models per se, but the arbitrager who wants to take advantage of this opportunity will have to invariably spend more time to do this, and it will cost them more. So we're at a very peak level of godlike math where your marginal returns for arbitraging are actually diminishing. And this might just possibly be a point where you say to yourself, it may be time to fix the math models. That's all I have to say about that.